Good morning, afternoon, evening, everybody, from wherever you're joining us. Today, we have a very exciting session ahead of us. We'll be hearing from David Hayes, Chief Investment Officer at BP Ventures, with a very interesting story from how he came into the world of corporate venturing from the world of finance initially. But first, before we get started, I wanted to quickly set the stage so you all have some context. My name is Alba. I'm part of the 500 Startups team. We at 500 are one of the world's most active seed stage investors with over 2,500 direct investments into startups from 75 countries. And within 500, I'm the head of global innovation strategy, where I work closely with corporate investors and innovators to power their own projects, partnerships, and investment into startups. And about 6 months ago, we started the CVC Insiders event series as part of our efforts to build a stronger and more supportive ecosystem for startups, corporates, and investors alike. So if you'd like to connect with a community of over 1,000 investors and corporate peers, feel free to shoot me an email that I'm now going to be dropping into the chat. And we host this roundtable bi-weekly featuring some of the top corporate venturing practitioners and have them share their own unique journey into CVC, specific challenges, best practices that they have developed as a result. So if you have any speaker that you'd like to nominate for the series, also please let us know. And for today, our host, Nicolas, will be moderating a discussion. And there's also a Q&A function, so feel free to ask any questions that come up along the way. So Nicolas, the floor is yours.
Thank you, Alba. So today you're in for a treat. David Hayes, managing partner at BP Ventures, is extremely experienced about corporate venturing. And even in the last 15 minutes when we were doing our setup check, I already learned a few things. So I'm really looking forward to learning more from David today, and I'm sure you're going to learn a lot. David, would you like to take 5-10 minutes to introduce yourself and how you got into corporate venturing?
Sure. Thanks, Nicholas, and thanks, Alba, and everyone at 500 Startups. This is super cool to be a part of this group of conversations. I'm really happy to be here. So my path to venture, actually, I think it was Jacqueline from Munich Re that said that she didn't know what corporate venture was or venture capital was before she got into it. And I'm absolutely in that camp. I started life in BP almost 19 years ago now as a financial accountant. In fact, sort of tracking my history back to how I got there at the age of 11, almost 30 years ago now, I did a week's work experience in an accounting firm, read a bit about the subject, and my sort of childhood brain at the time saw accountants as these kind of white knights looking after the investors, mom and pop investors that wanted to protect their money. So I kind of decided that was the career for me at that time. I did my A-levels, went and did a degree in accounting. I'll be honest, I think this is actually similar to James Mawson. Not the best student, I'll be honest. I was not doing particularly well in my degree, if I can be candid. But I spent the third year of that 4-year degree working for BP, and it turned my head around. I sort of almost immediately knew I wanted to work in energy and actually work for BP. It was such a fantastic experience that year spent in London in the finance department. So I went back to uni, graduated, joined BP as a graduate, and then through evening school and weekend studying, managed to get my accounting qualification. So hard slog, 4-year degree, and then 2.5 years working and studying at the same time to become an accountant. And after my first set of really large statutory accounts that I had to write and get audited, I did my level best to get out of accounting as quickly as possible, because that sort of rearward looking view is good for some, but I thought there was actually more to working in energy and more to working at BP. And through various roles and jobs over sort of the next 8 years or so, I ended up being the financial controller for a little group called Alternative Energy Ventures at the time. And this was sort of back in the 2007, I guess-ish timeframe. And so really I was there as the planning and performance kind of financial accountant for the group. I was sort of wheeled out every month, every quarter to update the plan and the view of what we were doing, and just started to little by little get a little bit more insight into what venture capital was and what corporate venture capital was. And I think there was a good conversations. There was a couple of really great folk in the team at the time. I've now gone on to do different things, but it was really through engaging with them that I got a little bit more involved in strategy and sort of portfolio shape in terms of coming up with better KPIs for the team. And little by little, I started elbowing my way, I think, into the team more broadly to actually help with financial diligence. And so, I think getting a little bit more involved, sort of bringing a bit more of a commercial lens or a financial lens to the work that we were doing and the investments we were making. And then 10 years later, here I am, managing partner for the commercial side of the group. So my role broadly encompasses the investment processes and portfolio management processes, as well as the economic modeling for deals and term sheet negotiation, structuring, and exit sort of management. So we're a team of about 15 people, but 5 or 6 of us very much focus on the commercial side of things and making sure that we make smart investments and that we look after BP's dollars. So yeah, for me, it was, that sort of 2007 moment. I had no idea what venture capital was, even as an asset class. And so, various roles of stepping through and up the organization to now, leading the commercial side. So yeah, it's been a fantastic journey.
Thank you, David. I'll start with a very simple question, but I think it's a good one about your background, which is you started with a finance background.
Yeah.
How much of that do you think is useful for your current role, as well as how much of that could create the wrong bias for making the right assessments?
That's a great question. So I am biased. I will state that up front. I think a financial accounting qualification, or at least a basis, is fundamental to make smart decisions when it comes to investing. I think absolutely you can invest through a technology lens, but I'm actually speaking to a class at Berkeley in a couple of weeks on why just the technology isn't enough. Right? I would say we in BP invest in people, not in technology, because great management teams are required to make these companies successful. But you also need to really focus on the size of the market, the amount of the product market fit, how they're going to make money. I mean, this is the thing: you've got to be cash accretive. You've got to be able to solve a problem and make money doing it. Otherwise, you won't be successful. And so, no, I think it's really key, Nicholas. And what I would say is for corporates, depending on the model that you have, some of us are very much focused on the strategic, some of us very much focused on the financial. I think having a balance. For us at BP, we hold that if we are going to invest in a company, it's because we see a strategic way for us to work together, whether on from a deployment frame where we're actually going to use the technology directly, or maybe it's a value chain participation frame where we're going to be an input or an app or buy the output of a particular technology. If you can get our interest and if you can find a way for us to work together, there should be strategic value for the parent. There should be value for the startup through that relationship. And because that startup's seeing value, we as the ventures team should also be able to see value because we expect that business to grow. So
I think there is even an argument to say that if you get really good financial return on one of your portfolio company, it's likely correlated with the quality and quantity of the learnings back.
I would say that's maybe a little more difficult to prove. I mean, certainly for us, and there's been a change in strategy in terms of how we've invested over the years, and why we've made investments. And actually, we've got our fingers crossed that we have a pending exit that will, be that one that pays for the fund that we're all searching for. And actually, it's one where the strategic value or the strategic relationship went away over time, and we were able to manage it as a financial investment. We were able to double down, triple down on that investment, and now we're very hopeful that we're going to have that one that pops and sort of pays for everything. So I would say, but you do make a good point, Nicholas, because our model has changed. We started in the sort of 2007 timeframe investing in technologies that were directly hedges against what our alternative energy business was doing at the time. BP Alternative Energy was a startup itself, a startup inside BP, and then we were a venture capital group inside a startup. And while they were doing monocrystalline PV we were looking at thin film technologies, and they were doing LC ethanol. We were looking at different pathways to different types of biofuel, and there was no strategic link. And maybe we were taking too much technology risk, or it could just be the market economics of, say, an 07 vintage clean tech fund. But that fund, didn't do so well, as did a lot of other folk investing at that time. I'd say our second kind of fund, so our second 4-year investment period, so from around 2010 to 14, was a little bit of a transition fund, moving away from just technology investing through to this sort of strategic investing and making sure that there was a link between the parent and the startup. And that's the way we've been investing ever since. And actually, if we look to our future performance, there is a correlation, to your point, between good strategic value to the parent and good financial value to the portfolio. So I'm not saying it's always the case, but there's certainly, I think, the more you focus in on that and make sure there's alignment, then I think you can actually drive that correlation yourself.
Very nice. And I'll touch on the alignment. But before that, I want to double click on something you said, which I think is probably for the audience, very important mindset. You mentioned about being a startup inside a company. Can you explain a bit more about what are the pitfalls with that, but also what are the benefits of feeling like a startup inside a company?
That's a tough question. The frame I used was actually alternative energy was a brand new business, and we were an entity in that. But I think even now, BP Ventures as part of BP, we do have to hold ourselves a little differently. We do need to think with more agility. We do need to be try to be quicker than, say, our organizational design. And I think that sort of mentality of trying to be founder friendly and really balance, I'd say, the wants of the parent and the needs of the startup to make sure you can create a win-win situation as opposed to create an imbalanced situation is really, really key for us. I'd also say we're very active on the portfolio management side of things. And so for virtually every deal, we have a board seat. And so a member of the BP Ventures team will have a fiduciary responsibility to that company. And so, we do have to wear the sort of two hats in conversations. We are for our startups. We are there to make sure that our founders feel as though they have a safe harbor with us as an investor, which I think is critical in these sort of large corporate, small company relationships. And so I think we do have to think slightly differently. We do have to be for the innovation and the pace, and we do try and have to hold our employer and our parent to account in terms of that delivery. So there's a tension there, but it's, to be honest, I think it's an enjoyable tension if you can manage it in the correct way. But there are points of misalignment. You can get misaligned, and it does take a lot of conversation and education to make sure everybody understands why the corporate venture unit exists in the company, and what your track record is, and what you're delivering, and what the aims are.
And I think nearly most of the discussion about best practices is about, for a CVC, is about ensuring the best possible alignment while having different stakeholders you need to really serve. Yeah. And are you entrepreneurs first? Are you about the mothership? All of that is very, very tough. And that's where it leads to my next question, which is on the opposite side of a startup. When you started in 2007, your job and your background, but your job was about measuring financial performance. So you definitively come with that bias. And what I would like to ask is, how much of that focus initially helped BP Ventures become what it is today?
That's the thing. I think you can always lose sight of the financial return, right? To be candid, even if every investment we made was a 10x cash on cash return, it doesn't really move the needle for BP. I think it's fair to say. Now, obviously, they would appreciate the 10x return on every investment.
They will take it.
They would take it, but it doesn't really move the needle. But as I say, I think you can't have one element of value without the other. So you do need to make sure that you're keeping an eye on it. What I would say is, and I think the accounting background, or maybe my bias towards finance, also allows you to be a little bit more flexible around business. Having spent 8 years working in a commercial capacity or financial roles, you know that plans are just that, they're plans. They change, they flex, different things happen. You can't necessarily meet your numbers every time you set them. I'd say that the one thing that my team and I are comfortable with is whenever we see a business model, we know every single number on there is likely incorrect. And it's a way of actually, through experience, building an envelope of comfort around a trajectory or how you think a company may evolve over time. So I think looking at the past and getting comfortable with the foundation, but then using that as more of a guide than necessarily a set number of sort of markers that you're going to sort of pick up along the way. I just don't think you can ever really take your eye off the underlying fundamentals of the business you're investing in, because you need to take it up to the higher level. If the company isn't making money, it's going to need more cash. And you as the investor, if you're a good corporate investor, that means you're in for the long haul. You're going to have to invest over multiple times, right? You're going to have to be in the round A and the B and the C. You can't just walk away. So I think having an understanding of the fundamentals of the business, how it can grow, and what that sort of lifetime cash requirement is going to be is key.
Very nice. So let me ask about moving the needle, because I think that's a good one. First, just for the audience, could you share your annual budget fund size, the size of BP itself, and what would BP Ventures moving the needle for BP look like?
The size of BP itself, I think we're, depending on the share price, in the sort of 70-ish billion market capitalization, in and around that range. BP Ventures, we have invested around $850 million to date. But what I'd point out is those first several years of investing, we were investing, I'd say between 0 and 50 actually. We had a few years where it was really quite low. For the last 2 or 3 years, we've invested around $150 million a year. And our forward-looking plan is to maintain somewhat that level of investment. I will say we recut our 10-year plan every year. And so there is the opportunity for that to change. But I think we feel as a group that in and around that 150 for the current activity set and the current focus and support we provide BP is roughly the right order of magnitude. So 850 million to date, we've invested in around 60 companies through that. I would say 40 of those, 35 are still live. And in terms of what we've delivered to the parent, I would say we feel fairly good with our track record. Obviously that first fund, as I mentioned, was a wash, was a zero. But if we look to the next sort of 10, 12 years of investing, we've got much more focus on strategic agreements or commercial arrangements with these companies, some of which have yielded fantastic returns to BP for the dollars invested, and hopefully have enabled those businesses to grow. And we've got a few that are going through the sort of pathway to exit right now. So we are certainly small in comparison to the big BP, but as part of the R&D ecosystem, let's call it, within BP, I think you've got VC, obviously, internal R&D, sort of university relationships, M&A, and sort of JVs and partnerships. I would say that our feeling of how we're positioned from a capital perspective is probably quite reasonable, considering the risk return and the scope that we can get our arms around with the team size that we have.
Very nice. And maybe from a tactical point of view, how do you document all these successes to R&D and to the businesses, and how do you put that into a storytelling?
Yeah, storytelling, that can be a bit of a challenge. Fundamentally, corporate VC is quite a complicated activity set, right? So certainly if you're investing in it for different things in different places, so we started, as I say, investing in hedging technologies, essentially, and we've spent the last 10 or so years investing for deployment. So opportunities to access technology. And I say now we're also dipping our toe in the sort of try before you buy or invest to acquire. And that's partly because we've created a fantastic new vehicle for us called BP Launchpad, which is a scale-up vehicle where we would take majority ownership, throw resources at an idea, and then try and get it to a scale where it's actually more material and meaningful for BP. So I think that whole piece of being able to invest for learning, invest for deployment, and invest for acquisition, kind of the three legs of the stool for corporate VCs is important. We have invested where the strategic value is qualitative. So an investment in a fast charging battery technology company was really around putting our weight, BP's weight, behind ultra fast charging as a concept. There was no real way we were going to be buying those batteries or using those batteries in our operations, but it was really around creating market pull in a particular way. We've got companies where we've deployed them, and that's actually our business unit reports back to us the dollars on the P&L that they think they've generated from revenue, or they think they've saved through cost savings. So I would say from a strategic value perspective, we take where we can, and I'd say this is probably in 9 out of 10 cases, we take a very quantitative approach where the business reports to finance the value that they've seen from the deployment, and then we hold that as MI. And then obviously our returns on investment are, cash in, cash out. But we try and package that all up in terms of a story around individual funds, because they do have slightly different strategies and a slightly different return on investment profile, strategic versus financial.
Okay, very nice. So one thing that's very obvious is you have had a few changes of CEOs.
Yes.
And when I started, people said you're only a CVC when you have survived one CEO change.
Mm-hmm.
I think you've done 4 of them. But on top of that, you have a few changes even on the structure of the investment committee.
Mm-hmm.
Can you talk about the transitions and maybe what you've learned through these transitions about best practices? Very high level to start.
Sure. Yeah. No. So I think you're right. We did start when it was Lord Brown, and now Bernard Looney took over in February of last year. So yeah, I think 4th CEO, I'd say largely maybe our 3rd, if not our 4th iteration of the investment committee, and I'd definitely say our 3rd mode of investing in terms of what we're looking for. I think what to say. You've got to be open to tell the story again and sort of re-explain and retread ground, I think, in terms of why corporates venture, why does your corporate venture in the particular way that it does, what has the track record been, what have the lessons learned. As I say, it's a kind of a complicated activity set to get your head around with a number of different levers, and I think spending the time and being open to talk to whether it's new investment committee members or a new business unit CEO or whatever it is just have that dialogue and be very transparent. I think just taking the time to actually walk folk through, how you do an economic model for a startup, how you forecast strategic value deployment, why is the governance process what the governance process is. There's always a bit of a story and a track record. I mean, for us, we changed from an investment committee that was essentially just the head of a business unit. Because we were investing in hedges, there was always a bit of conflict between what the business was doing and what we wanted to do, and that had to be managed in the right way. We then moved to an investment committee that was very technical focused. And obviously the technical experts we had around the table had long track records of technology not working. And so it's having the right dialogue and making sure that you can actually narrow in on the perspective that made sense for the investment that was being considered at the time. I say now we have an investment committee that's very strategic focused. It's about does this have strategic fit with BP? What is the value from that strategic fit within BP? And then it's the question of, well, why do we need to use venture capital to access that strategic fit? I think they're all great questions, but there's certainly a different perspective of, going from, is it going to work to, we tried that before and maybe we shouldn't do it again, and then now, does it fit with the company in this energy transition that we're going through? So yeah, it's you just got to know what you're doing, I think, and know how to articulate it. I think that's key to manage those transitions.
Very nice. And talking about investment committee, normal question is to ask, what's the size of the investment committee? And you had the chance to have multiple iterations. So what do you think is a good size for an investment committee?
It's interesting. Whenever we talk about investment committee, we have to also understand, I think, the level at which it operates within the organization. Because we can just say, oh, my investment committee is 5 members. If that's the 5 most senior people in your organization, that's probably going to be quite challenging in terms of getting people to actually get around a meeting to actually consider an investment case. So, I mean, I would say our prior incarnation, so not the one we're operating now, but previously, was maybe too large. And I think we had a gentleman come in and sort of give us a kind of a view of industry best practice. And he pointed out that our investment committee was larger than BP's main board, so I think roughly there's probably 10 or 12 members. You know, it's quite hard to get, I think, consensus around an idea when you have that many.
And
right
different
now,
time zones, I guess.
Well, I mean, this is the thing. Diarising an investment committee meeting, it can present a real challenge. And when you're wanting to move at pace and get that term sheet out quickly, because it's a competitive deal, you have got to move. So I would say we've slimmed it down. It's now 4 members, and 2 represent kind of more of a functional bias, so finance and legal. And then our chair is David Eiton, the EVP of Innovation and Engineering in BP, and he's been the chair of our investment committee now for, probably going to get this wrong, maybe 7 or 8 years. And then we have an SVP of strategy engaged. And so it's really trying to focus in on what is that strategic fit. Is 4 people too many or too few? I think it's working right now. You know, we've got a good cadence. We have an investment committee every month locked into the diary, but we have the flexibility enough with 4 people to move it around if we need to, or get one out of cycle. So I think you know, what we have right now is certainly working from my perspective, and it's been this way for, I guess, 6 months or so. So you know, I mean, time will tell.
Very nice. And so you do a monthly investment committee. What happens if you don't have investment proposals to make? Is that a reporting time, or you just cancel it?
It kind of depends. So we can give the time back if we've got nothing. We have, I mean, it's worth reflecting, you know, BP's just gone through a massive transformation of itself as a company. It's announced by Bernard in February on our mission to net zero. And so there is a lot of reprogramming the organization going on right now, and ourselves included. You know, of our 4-member investment committee, only one of those members actually knows us as people, right? So we're having to, you know, engage with those 3 other folk, you know, not only through the venture activity, but through our lines of influence within, you know, legal function and finance function, everything else, to really explain why we're doing what we're doing. So, you know, there's certainly something we have to do there to try and engage and get everybody on the same page. So we have been repurposing those sessions. Sorry to answer your question. We have been repurposing a couple of those sessions for that education piece. But normally, if everything was working, if we didn't have a meeting, we'd probably give it up, or maybe do a portfolio review of a couple of interesting companies.
Very nice. Now I want to shift gear and move to something which is probably important, especially when you look at all the new CVCs coming up.
Mm-hmm.
GCV talks about between 20 and 25% of minority equity investments from corporate are new corporates. Mm-hmm. So clearly there's a need to raise the bar. That's also why we do these interviews. What's your view about how to measure the quality of the CVCs, and what would be meaningful benchmarks?
Yeah, quality is a tough word. I mean, to touch on your earlier point, Nicholas, I think longevity of activity is a yardstick I think we all need to be reaching for. You know, we can all reflect corporate VCs historically haven't had great reputations in the market, right? You know, let's ignore the whole dumb money comment that used to be thrown our way, because I kind of don't believe that's the case. You know, the whole concept of being able to invest in a company once and then sort of just, you know, hang out on the cap table and, you know, just sort of ride along. I don't agree with that as a sort of investment mentality. You know, I think if you've got the privilege of sitting on a cap table and you're a big name, everyone's going to ask the question, well, why aren't they following on? What's wrong with the technology? Why don't they support us anymore? You know, I think you've got to go into this with a long-term mentality.
It's a commitment.
View. It is a commitment, you know, and this is the thing. I'd say when we started this, we thought those commitments would probably be, I don't know, 3 to 7 years. The fact is that was maybe the case 10, 15 years ago, that companies stayed private, you know, 3 to 7 years. What we're seeing now with the various market dynamics that we're facing, companies are staying private longer and longer and longer. Now, obviously, there's the whole SPAC thing, which we maybe don't need to get into right now. But these are long-term relationships. I mean, and that's how we see them. We see them as relationships. They're not investments. You essentially get married to your founders, right? And occasionally there can be some changes through the evolution of a company. But these are long-term commitments. We hold that we will be in our company as probably 7 to 10 years. And to be honest, how we think about our funds, it's 4 years of investment and then 6 to 8 years of unwinding. It's probably more like 8 years of unwinding. So we're talking about a 12-year commitment there for companies. And, you know, having a view of lifetime investment and what the capital frame of that company is going to be is going to help you manage that and help manage your internal stakeholders as well. You know, having the freedom to follow on and make those smart investment decisions to make sure you're obviously looking after your parent company capital, but making sure that the incremental economics of investments are actually making sense. You know, that's something you have to do. You can't just do one and done. So I'd say longevity is definitely something in there. I think consistency is somewhat similar, slightly different. Is, you know, you're not changing your model too much. You're not changing board members too frequently. That they know they're going to have a team that is actually going to be there throughout that journey. Okay, there may be some changes. So I think making sure that the folk that you have in your team are part of some sort of accelerator program internally that are kind of spinning in and spinning out and going on to do other things. I think making sure you can incentivize your staff, making sure they feel good about the job they're doing, that they feel a commitment from the company to them to do this activity. I think creating that kind of long-term mindset, both on an investment place and on a team kind of dynamic, I think is actually important.
I think consistency, especially around behaviors, is what defines a brand. So if you want to be known for certain things, you have to be extremely consistent. I want to triple click on something you mentioned about the follow-on investments, because indeed it's a commitment. You're serving the entrepreneurs. How do you think about the follow-on investments? And I want to understand, when would you decide not to do a follow investment? When would you simply do a pro rata? And when would you consider a super pro rata? What would be the considerations?
Great questions, Nicola. Sorry, Nicholas. Excuse me. So in terms of follow-ons, all the way back in the distant beginning of BP Ventures, every single dollar we put into a company had to go to investment committee. So that meant every single follow-on had to be reapproved, which presented a couple of challenges, certainly for you as a board member or a person engaging with the company, because even though you're wearing your fiduciary hat and we have a separation between shareholder and board member responsibility. So for the companies I sit on the board of, I don't get to make a decision as to whether or not we follow on.
That makes sense.
Someone else in the team is charged with that to keep me clean, you're focused on the company, and they take the shareholder view to make sure we manage any sort of dynamic there. But we have moved to a place now where we take initial investment cases forward with a concept of lifetime investment. Now, obviously, that can't be from birth to death. It's more from a stage kind of perspective. So if you're investing in a Series A, your lifetime investment probably gets you through to your Series C kind of growth phase. You know, if it's later, it's probably something a little different. So we do try and articulate that. And then follow-ons are actually managed within the team. So there's a delegated authority from our chairman of the investment committee down to the team to actually manage those follow-ons in a structured way. And typically what we do when engaging in a follow-on is making sure that there's still strategic alignment and understanding that the strategic relationship. Also understanding if there's maybe something that's become misaligned, and through following on, we can actually realign that relationship. And that could be as simple as, you know, the technology was developing in this way and it's going great and the business is really happy, but now the business actually wants something different to happen. And so we can actually use our investment to direct maybe a branching technology or a different sort of flavor of the technology as part of the follow-on funding. So that's one piece. But ultimately, we have the authority, when strategic alignment goes away, to manage our investments from a financial basis, just to make sure that we are, you know, the business is performing, it still makes sense, it may have pivoted, it may not have, maybe it's just our strategy has changed. We're able to manage it as a financial investment, making sure that we keep an eye on our strategic value return and the financial value return as a combined IRR of the portfolio. But to your question on not following on, it's the hardest decision to take. So let me answer first. We typically say that if a company is performing pro rata, we want to maintain our stake, allowing for the fact that if it's a big new round, the new investor will set how much is available to the insiders. We'll always be flexible there. Sometimes we really want to take our 10%, but the round's oversubscribed, so maybe we come down a little bit. We try and facilitate what goes on and take a sensible view. Where we see real strategic alignment, and maybe it's in this try before you buy mentality, we might then sort of double down, triple down, and increase our ownership with the idea of potentially acquiring in the future. But the decision to not follow on, it's the decision we all hate. We hate having to have that conversation. Aside from sitting on the board of a company and realizing that you've got a cash crunch and you need to maybe let a few folk go, I would say the decision to follow on is the hardest investment decision you'll get to make. But sometimes some ideas just don't work. They're just not scaling. They just aren't generating the margins that they were set out to do. We try and do it in the gentlest way possible. I know that sounds like total BS. But what we will try and do is facilitate as much as possible, either handing off to a new set of investors or being there to answer questions as to why, and really opening ourselves up to sort of explain the decision. We realize the weight our name carries on someone's cap table, and our decision to not follow on is terrible for the company. And we've got to manage it in a sensitive way.
Yeah, no, I haven't gone through that, but I can imagine it would be very hard. Actually, there is one thing which I find very interesting in what you said, which is new concept for me, which is when you invest in the company, there is clearly a strategic alignment. Mm-hmm. But you mentioned something which I didn't think about, which is at some point, maybe the strategic alignment goes away and you need to follow the investment. And what you're saying is actually it makes sense to be in the team of BP Ventures to decide to follow investments because one, it's not your fault or the entrepreneur's fault the strategic alignment goes, but you continue to serve the entrepreneurs, you continue to serve your portfolio companies. And so the question is, would follow investments take into account the strategic alignment still to decide, for example, between a pro rata and a super pro rata, or it's really purely about financial and serving the entrepreneurs?
I'd say it's almost purely around serving the entrepreneur and what makes sense for the company, and for us from a financial metric basis. I would say so. In our previous incarnation, we had a financial IRR target and a strategic value target for every deal as we took it to investment committee. We've now blended those together, but the ventures team and the commercial team still maintains a target on both of those, even if they're not communicated, and actually also has a materiality threshold that it wants to maintain as we go in. So when it comes to follow on, if say the strategy is just totally changed and we're no longer going to do X in Y region, and so the company doesn't work, we would, as a base case, if the company is performing, pro rata. Not saying we're going to commit to that or anything else, but just as a rule of thumb, a hypothesis to be disproven, let's say, we would expect to maintain our ownership. If it makes good financial sense, if we still see line of sight to a liquidity event where we will return capital. And that's, to be honest, why we are quite rigorous on that financial piece. To go back to your earlier questions, as we go into an investment, we don't just want to invest in good businesses for BP. We want to invest in good businesses because we need to be able to continue to support them. So we need a good reason to be able to continue to support them from a financial basis in the future, just in case. I would say we're losing alignment less frequently now than we used to.
No, I think that's a golden nugget, and I want to push it to the limit. Let's assume that, and
hit me.
You have this portfolio company, strategic alignment. You invest in them. The strategic alignment goes away, but this company is like this unicorn. This is financially where you want to actually double down. Is that a case where even though the strategic alignment is gone, you would go super pro rata?
I mean, I wish I had an experience to reflect on, Nicholas, in terms of having a unicorn in the portfolio. We haven't had one yet.
Soon.
To be honest, we've just gone through a conversation around a follow-on because of the process it's going through. And it was outside the delegated authority for the team to actually write that check. And so we did have conversations with more senior folk. And I guess to do the math, we did go more than our pro rata because we saw the value. And so I would say never say never. I think there's a lot of smart people in BP, a lot of commercial experience. So I think presented with the right opportunity and the balance of risk reward, yeah, I'd say we probably would. Even though I can hear the chair of our investment committee saying we're a strategic investor first and foremost, and we are. I think we are flexible though. We do try and be flexible. We know these companies are going to need different things at different times, and they're going to evolve in a way that we probably don't expect. And so I would hope if we were presented with an opportunity where it was a real good financial return, that we would be able to do that.
I think your point is very nuanced. You are a strategic CVC. You invest for strategic reasons. You're financially minded. When it comes to the follow investments, it's you being entrepreneurs first. And I think this nuance is very important to understand and a golden nugget as far as I see it. Now, I want to move to a question. Oh, sorry, you wanted to add something.
No, I was just going to say, I think the founders first mentality is something that we work very hard on, even at the initial investment. So, if we're lead, well, we like to lead term sheets. I would say we don't mind following, we don't mind syndicating, but we like to lead. We like to lead because we make sure our term sheets, if it's a Series A and there's no rounds before us, you will find the most vanilla, inoffensive, blank sort of sheet, NVCA, BVCA, whichever VCA standard term sheet. 1x non-participating preferred shares with no dividends. Right, we know that we need to build the most critical part here is building alignment between the founding team and the management team and you as an investor. Right, you've got to create the win-win dynamic. You've got to create the right relationship of trust and being in it together and wanting to deliver together. I think there's some there can be really aggressive term sheets out there, and unfortunately we've had to in certain cases put pay to plays in or multiples on liquidation. Never at a Series A, but later on, when things change. But I think actually, you need your management team to be on board, right? You've got to have that alignment. You've got to be founder friendly, founder first. It's kind of family. So,
actually, I'll give credits to 500 startups. I attended one of their programs called VC Unlocked, and one of my top learning from this training, which is 2 weeks. Was if you start to be tough on terms like at seed or Series A, that's actually not good for you as an investor, because the terms get even tougher after that, and you start to stack terms that actually are not good for you as an early investor. And so it's very short-sighted to try to go anything beyond vanilla and what's market.
It is, and actually my advice to founders is to not be so concerned with pre-money valuation. Be far more concerned with all the other terms in there. Now, I know there's a certain amount of personal pride in the valuation of your company, but it's better to build a story of growth of value rather than have someone come in and think you're overpriced and then put a 2x liquidation preference on or add participation rights. I think it's better to grow more slowly based on the fundamentals and trying to keep the liquidation stack as clean as possible, because it has just alignment through the stack, and it will serve you over time.
And I think it sounds like a really good advice to entrepreneurs, but actually it's a really good advice for investors. So I have a question. So we're moving to KPIs now, but I have a question from Ueno-san that's really good, which is about how do you build a CVC team? And I want to start with, how do you build a CVC team that will have a really good alignment with your mothership?
Yeah, it's interesting. So, if we go back to our team has just changed. We've actually seen, we're a team of roughly 16 people, and we've just had 6 colleagues from Ventures previously leave and 6 new colleagues join. So actually a team in transition. The primary incarnation of the team, most of those folk actually came from technical roles within the organization. And so they're able to speak the same language when it comes to pain points and technology deployment and why technology should work and that kind of thing. So they have that internal network of being able to sort of talk the same language. So I think interconnectivity is actually really important in corporates, certainly when you're wanting to drive strategic value. I think hiring in folk from external where they don't have that internal network is probably quite tough. Now, we've got a couple of great folk that we brought in from external. So Megan Sharp, who's our head of ventures, joined us from, she's got prior experience in VC before joining us, also PhD, MBA, I mean, honestly, brainiac. And she joined, she managed to build that network in those early days through with her bio PhD with the biofuels team. We've also had Erin Halleck joined us from the British Growth Fund in the UK, and she's on that journey right now, sort of building the network internally, but being able to leverage strong technology experience and investing experience to do so. I think having a good mix of folk that are interconnected into your corporation and folk that maybe hires in. We've also hired in folk from the venture debt market, from other corporate VCs, and so while they may not have the network, they at least know how the game gets played inside a corporate VC unit, so they can kind of talk the same language. I think having a good mix of commercial skills and technical skills as well is critical. I mean, let's be honest, we're all trying to move to a much more D&I type mindset here, not only just in terms of how people look, but how people think and act and behave. And I would say, we are taking the D&I best practice from BP into the ventures team and actually trying to push it out into our portfolio, promoting good D&I practice when it comes to hiring and as we look for changes and everything else in management teams and even board structures, right, trying to push D&I. So I think having a diverse group of individuals, but that are all passionate about technology, commercially sharp, and love leaning in and working with founders. I mean, that's a good corporate VC team in my mind.
It's interesting you mentioned Megan and D&I. I remember the first time I went to GCVI, January 2019. Megan was on stage with 3 other women talking about diversity, and she made a point that I thought was super, which is, how can we talk about diversity when we are all women in the panel?
Yeah.
And so maybe that's something we will invite Megan for a special edition of this series, but I think that it's not up. Sorry?
I'm sure she'd love that.
Yeah. No, she actually at that event, she was the one who impressed me the most. So definitively want to invite her in some form or another. When we talk about, let's talk about inclusion, because maybe this is the one that's talked less and less obvious. How do you encourage inclusion for your portfolio companies in a way that works versus just telling them and what happens?
Yeah, no, it's a good question, because there's only so much influence you can have as a board member, and to an extent, there's only so much influence you should have as a board member as well. That the team has to deliver and work together. But I think, as with the leadership, we try and take in safety and good health and safety practices. It's making sure it stays top of everybody's mind. Not saying you can necessarily manage this stuff with KPIs, but sure, you can have a diversity KPI that you're showing. But if the people that are seen as diverse aren't included, you've failed. So I mean, the one thing I like to have, as board director, is that it isn't just hearing from the C-suite, right? You don't just hear from the CEO and the CFO every board meeting. You want your VP of engineering to come in, or you want your chief people officer to come in. I think having different perspectives and different levels of folk in the boardroom talking about the company and the company performance and the challenges is really important. Obviously, without COVID and not being able to meet people face to face, I think also as a director, you should be meeting the different layers of the organization and hearing what they have to say. I think through that you'll uncover challenges or differences in viewpoint and anything else. And I think the more you hear, the more you learn, the more you interact, the more you can then direct the conversation at the top of the house to make sure that the appropriate changes are made. I mean, for us and I think I'm right in saying this, we have agreed for every board we sit on, the first slide or the first topic of conversation at every board meeting should be health and safety. I don't see why D&I or the people agenda doesn't also elevate itself to a similar level.
Very nice. I have a really good question from Barrett Parkman, and I realized that we touched on it and hinted on it, but we haven't actually really been specific about it, which is beyond driving collaboration between the startup and your own corporation. So beyond that, how do you add value to startups?
Good question. I'd like to say, through sitting on the board of the company, the folk that we have sitting on boards have been in the energy space in venture for, I'd say between 10 and 20 years, some longer, either with a strong technical background that can actually help with the particular technology of that company, or with a finance background to help you on your audit committee. I think there's a different way we can all leverage our skills in. Plus, we're I'd say reasonably well networked in terms of finding co-investors, in terms of finding new employees. We've got a great legal function, a great tax function. We've got a great communications function. We've actually had, a guy, he's no longer with us. He went off to start his own thing, but fantastic at kind of the marketing messaging and the communications messaging. We've had him leverage in and actually help startups craft their story to the external market. So I think as a company, I'm not saying we're almost a full service shop. We are very conscious of our venture offer, though. We are definitely more than dollars. So hopefully you'll get a great board member to help you grow your company. Hopefully that board member will be able to leverage BP, the parent, in whatever way necessary. And then as a group, we're able to find co-investors, introduce you to banks for debt, introduce you to good law firms, IP firms, search firms. Yeah, we will do whatever you need us to do. It's kind of a servant kind of offering, I think, for us.
I like the term servant, and I like the fact that everything you touch is what matters for a startup to be successful. Mm-hmm. They need to have the next round of financing. They need to have the right people, the right recruitment, the talent, and all of that. And all the support that seems administrative really helps them. So I think you're being extremely wide in your servant services. So that's really, really important. Now, I finally want to touch about KPIs. So you've got this 15 years of experience running this corporate VC, many changes over time. Which KPI has stayed pretty much the same? And which ones have you introduced in the last 2-3 years that you actually feel very good about?
So we haven't really changed a lot. We started, I guess what has changed is we now feel comfortable stating what our KPI is. So we started with the idea that, we would maybe there's a different one. So we obviously framed this up at the very early days. Venture capital, you invest in 10 companies, 1 is a success, 2 wash their face, and the other 7 crash and burn. I would say we've now introduced a KPI where we expect our loss of companies to be far less than 70%. And that's partly because of the strategic programming and making sure there's that connectivity. If BP can get comfortable with the technology and the company and the startup will be seen as a good business plan and a model, the chance of failure should be lower. So we're saying that we think we can do better than a 70% failure rate. We think it's actually better than 50%. And when I say failure, it's no strategic dollars and no financial dollars from engagement. I think IRR over the lifetime of the investment is one that stayed pretty consistent. I would say what's happened though is we've increased the hurdle that we expect to deliver. And I think that's largely, again, because of the strategic alignment and everything else. But also we're a smarter team than we were. And we're investing in, I would say, the types of technology that the world's crying out for. And so the likelihood of that being valued, I think, is better than it perhaps was in an earlier incarnation. We have a strategic value hurdle that is dollars that we want to deliver back to the parent. We've actually now combined that with the financial into one measure just to make sure that we are balancing them both. As I say though, the commercial team behind the curtain, keep a good eye on both of them separately to make sure we're not, investing for great strategic value, but the chance of actually you're paying far too high at pre-money and there might be a down round and everything else. So we've combined two metrics together. So we've added one around, not a failure rate that we want to beat, and we are keeping track of D&I in terms of diversity in the C-suite of the management team and the next level down, as well as on the board. I'd say that's more of a reporting function to see if our message is landing and if we're able to make inroads. I think that's roughly all we manage. To be honest.
So there are two things that I like, but let me ask about the D&I KPI. How do you measure that KPI?
Each board member reports out to the team in terms of the top positions in the organization and the makeup of those folk and the board, colleagues on the board.
Very nice. And then back to one thing you said, which is now you're comfortable sharing your KPIs externally. Why did you not do it earlier, and why do you think it's so important? And this is really for the audience because it's very hard to feel confident to share your KPIs externally. You might think you're sharing your secret or something you're not supposed to. What would be your guidance?
I think because this is a long-term activity, and actually I'm having this conversation right now. If all of your if all of the positive returns are forecasts and the actuals are zero, how can you have any faith in you're actually going to deliver those? I think you have to build a bit of a track record. You have to have some scores on the board to be able to feel as though your model actually works and you can feel comfort in your return profile. I think that's really what it comes down to. If you're year one of a CVC and you've made 2 investments, projecting a 30% IRR or whatever it is okay. I mean, well, good luck. I hope that's the case. I think without a track record, it's very difficult for anyone to actually really say what their KPIs are going to be because they're a target. They don't actually know.
Yeah. Okay, we are in the last 2 minutes of our interview. I want to end with an inspiring question. You went to Texas, you got blocked in Texas. So clearly there was a lot of thoughts around energy you must have had at the time. What do you think is the value of corporate venturing to solve these energy related problems? What can we expect to see being solved with corporate venturing?
Yeah, no, thanks for your patience with me as I was freezing in a rental car last month in Houston in the middle of their storm. Look, we as a company have committed to net zero, and not just for us, for people and the planet, and to help others get there. I see ventures as a core part of that strategy and activity of delivery. There are technologies out there that we're going to need, that are going to transform, and they may not be obvious today. So we should be there as a scanning function. We should lengthen the perspective of any corporate that we're working for. We should be raising awareness of potential disruptions, raising awareness of technologies that are potentially going to beat what we have internally. Finding the really smart people out there that have ideas that maybe don't fit into a corporate structure because they don't really like how a corporate feels. But we're there to find them, to fund them, and to grow these companies into the next generation of energy and how energy is actually going to work in the future. I mean, we're moving from an IOC to an IEC. That's a big transition. We're here to try and help find the people that are going to help us do that because we can't do it alone.
It's a perfect way to end an amazing interview. Thank you. Thank you so much.
Thank you, Nicolas. Thank you. Thanks,
Bye.
everybody. Bye now.